Hi everyone, I'm John Zoller, CIO of MAI Capital, here with your latest update on the markets. We're changing up the format this month to directly address the most common questions that we've been receiving from you, our clients, either through our email or through our advisors. So we're tackling the top 3 questions, and we'll start with, how can the stock market be rebounding so strongly with the economy still so depressed? And I think this is a great reminder that the markets are always forward-looking. So even though the economic data is as bad as it's been since the Great Depression, some incremental progress over the last couple months has been enough for the markets to rally strongly, looking ahead to the outlook for the next 6 to 12 months, a little bit better than feared. The second factor we think that's driving the markets, and we've talked about it, is the massive amount of stimulus from the Federal Reserve, global central banks, and the US government. In the US alone, the stimulus measures have amounted to over 40% of GDP, which is just unprecedented. And if we've learned anything from the past 10 years of this market cycle, it's that fighting the Fed has generally been the wrong trade. So when the Fed is supporting the markets as much as they are, it's generally a good time to be taking risk. And the last point that we would make is that the composition of the S&P 500 has really changed over time. And the sectors that have actually been least impacted by the COVID-19 crisis are now a much larger portion of the S&P 500 than they were just 10 years ago. And the chart that you'll see on the screen shows the sector breakdowns of the least impacted sectors and most impacted sectors in the S&P 500. And you'll see that sectors like energy, financials, materials, together have become a smaller part of the S&P 500 over time, whereas sectors like technology and communication services that haven't been nearly as impacted by the current downturn now represent a much larger portion of the S&P 500. And we think this is one reason why the S&P has recovered as much as it has since the bottom in March. The second most frequently asked question has been, what are your primary concerns for the investment outlook going forward? And we think that the first concern we have is related to equity valuations. Now, it's not unusual at this point in the cycle, when earnings are troughing and the recovery is just taking hold, for equity valuations to look extended, and they certainly do today. But nonetheless, we think that the markets are now pricing in a fairly uninterrupted recovery from here, which we think could end up being short-sighted. One of the concerns that we have is related to a second wave of COVID-19 sometime this fall. And we're paying pretty close attention to the data that's coming out of the states as they reopen their economies. At the national level, we haven't seen any real concern of a spike in cases, but state by state, there's certainly been some cause for concern there. So that's something we're watching closely. And the third concern we have is more long-term in nature, and it's related to the negative consequences around all the stimulus measures that have taken place so far this year. And the chart that you'll see on the screen is public debt as a percent of GDP. And you'll see the green dotted line is showing projections from the Congressional Budget Office for debt levels heading into next year. And you'll see it now eclipsing the 100% of GDP mark, which hadn't happened since World War II. And we think the consequences of the high debt to GDP levels will be some combination of higher taxes and higher inflation down the road, both of which would be negatives for the investment outlook. The third most frequently asked question is, where are you currently seeing opportunities in the market? This question has become a lot harder to answer versus 2 months ago because of the recovery we've seen broadly in risk assets. And the opportunities for strong risk-adjusted returns from here are certainly less pronounced than they were a couple months ago. That being said, we think just going back to the basics of having a sound rebalancing strategy, harvesting tax losses where available, and maintaining a well-diversified portfolio that can weather the storm and perform well in a variety of different environments, we think that's still the best strategy going forward. And when you think about stocks versus bonds over the next 10 years, we think the choice is still pretty easy for clients that can stomach the risks of the markets and the volatility. When you think about the S&P 500, which is now yielding about double what a 10-year treasury will yield and provides growth and appreciation potential, we think stocks for the long run are still a good bet to make. Well, we hope you found this to be helpful in the new format, and we would encourage you to respond to this email with questions, and we hope to be able to answer those for you directly in the months ahead. Thank you so much for listening, and we'll see you next time.